Hey, so we're joined by Gary Smart today. Now he's super, super smart. He knows about cryptocurrency. Now, Gary, I'm so looking forward to this interview because I know absolutely nothing about it. I know it's been a buzzword for so long. Everybody's talking about blockchains and cryptocurrencies and all those. And in fact, a friend of mine was telling me about it years ago and says, hey, there's this new thing called Bitcoin. And I'm like, don't tell me about it. I don't understand it. And if I don't understand it, I'm not investing. Now, that was when Bitcoin just started I was in LA. So I wish I listened back then, but I guess is it too late to learn about this? What's your
No,
experience?
it's. I think it's still the beginning. Though we all wish we could go back 12 years ago and pick up a few more at 10 cents or so. So
So
this,
can you
yeah.
explain to us, like, can we just take this time to really explain? Now, I know nothing about it, okay? So I'm obviously invested in other things, but if it comes to cryptocurrency, I don't understand it. And often people use the language that you use in cryptocurrency, people really get lost in that, especially those ones who don't understand it. We understand how the banking system, well, we think we understand how the banking system works, which really is an illusion in itself. But would you explain to us exactly what is it, and how do I find out more in a
All right. Well,
simple language?
let's go and see how we go. So can I share my screen out?
Yep, let me
Out?
just let you allow that. Um, oh, I'm sorry. I think I was sharing my screen. Sorry, I'm just stuffing this up right now. Great. All right.
Righto. So okay, got that?
Yep.
Oops. Righto. So this is my little primer on cryptocurrencies. So just a quick note about what we're about to go through. The crypto space has its own domain language and it consists of many technically complex terms and ideas. So what follows is hopefully a generalization and a simplification of this domain to help express some key ideas in everyday language. Now, of course, some ideas and elements don't translate exactly. So take everything I say with the understanding that it's a simplification and we can go many more levels deeper, but the key concepts are still going to remain. So, and please stop me if you've got any questions along the way. So
Yeah, definitely will.
So yeah, so a very brief cryptocurrency timeline. 2009 is when Bitcoin was created. It was created by somebody or some group with the pseudonym Satoshi Nakamoto. We don't know who or what they are. We just know that they created this thing called Bitcoin. And Bitcoin being the granddaddy of all cryptocurrencies. In 2015, another crypto idea called Ethereum emerges. It's not the second coin, but it is the second most significant coin at this point in time. Now, Bitcoin, from a market capitalization, is just trumps everything else. Ethereum is the second biggest coin out there in terms of capitalizations. I don't have the numbers off the top of my head, but Ethereum brought some ideas to cryptocurrencies in terms of what we call Ethereum virtual machine and smart contracts. Now, I'm not going to talk about these today. They're sort of more advanced topics, but it sort of moves cryptocurrency forward in terms of what it can do, because Ethereum allows you to actually create programs and apps and other cryptocurrencies on top of it. So it sort of helps accelerate the way things move. So I just make a mention of that as sort of a significant cryptocurrency idea out there. And if we fast forward through to today, there's more than 10,000 cryptocurrencies floating around. They're not all great cryptocurrencies, and there's still only a basket of, I don't know, 20, 30, maybe 100 that are sort of popular and in play. The rest of them, but we'll see what they are in a few slides time. So,
Gary, can I ask you a question?
Yep,
So
certainly.
just in regards to the different ones, like you're saying, 10,000 types of different ones. Is it similar? Would you compare it to, like, you've got, the English pound, you've got Australian dollars, American dollars, just different type of currencies? Is that how you would differentiate it and how you would understand it?
There's an answer that says yes, and there's an answer that says no.
Okay,
So
how about I'll just
we'll probably,
I'll listen.
yeah. I think that's a good question for the end. After we cover a little bit more at a few terms, I'll answer that. But there's cryptocurrencies and there's different types of ideas. So let's revisit that question at the end, because it's a great question. So a little bit of history on Bitcoin. It all started in retaliation to the 2008 financial crisis. It was found in the Bitcoin Genesis block. We'll talk about blockchains in the next slide or two, but a Genesis block is the first block, and we'll talk about blocks soon too, that is in a cryptocurrency. And encoded in the top block was a reference to this newspaper article back in 2009. So hence the theory and the idea that this Satoshi guy or group was in retaliation to some of the banking systems and what was happening around the place. So they created Bitcoin and the cryptocurrency idea to sort of like get back at the banks and sort of put the power in the people. At least that's what perhaps their vision was back then. And maybe now, 12 years later, things are starting to get a little bit of traction, because it was just a pie in the sky idea back when it happened. So we can't talk about crypto without talking about some technical terms, because it's a system that is built around technical ideas. So the first question we need to ask is, what is a blockchain? Now, I've just grabbed definitions here from Wikipedia, and a blockchain is a growing list of records called blocks that are linked together using cryptocurrency. I'm sure everyone totally understands that now. But what's that actually mean? Well, let's look at it from the perspective of a ledger book. So an old school ledger book, handwritten ledger book. So a list of growing records called blocks linked together. Well, it's a bit like, it's a public ledger out there on the internet. So if we just focus on the ledger book there and just follow me with this example, you'd start on the first page of your ledger and you'd write all your transactions down. And you get to the bottom of the first page, you total them off. Then you'd move on to the second page and you start putting your transactions down. You get to the end, you total off, then you move to the third page, fourth page, and so on. Well, think of a block in very simple terms as being like a page in a ledger. So on the left-hand side here, we've got the first block with some transactions. We fill up this block. Now, think of a block as just being a file on a computer. Like a spreadsheet, but it's got a set, say 100 rows. You can only put 100 rows. You fill the first block up, then you create a new spreadsheet, then you start working on the second block until you fill it up. And as the block is filled up, you put a little link or a note in the spreadsheet that says, now go to this next file, this next block, and hence they're chained together, and where the idea of a blockchain comes from. So very simple, it's a public ledger. Now, public means you can go out, anyone can go out to the internet and get a copy of this ledger and have a look what's in it. It's fully public. It's not like a closed ledger that you might have at a business or a bank. It's a fully open blockchain. So that is at a simplified idea of what a blockchain is. And the word cryptography pops up all along, which is all about security and encryption and stuff. And that is how blocks, I won't go into this in detail, but that's how stuff is linked together so that you can't fiddle and change stuff. And we'll see a little bit more about that, what that actually means in a later slide. So that's what a blockchain is in essence. So what's a cryptocurrency? Now, try this one on. This is from Wikipedia. A cryptocurrency or crypto is a collection of binary data which is designed to work as a medium of exchange wherein individual coin ownership records are stored in a ledger, which is a computerized database using strong cryptocurrency to secure transactional records to control the creation of additional coins and to verify the transfer of coin ownership. I'm out of breath and I'm confused. Even though I understand all the technical stuff in there. So how's that? Is that a cryptocurrency?
Yeah, you lost me halfway through, but yes.
Yeah. So what's currency? We use currency to do transactions, buy houses, buy groceries, send gifts. We might stick it under the bed, store it. That's what we've got. It's got currency, it's a medium of exchange, and that's all cryptocurrency is. It's something that we can use to exchange now. But yeah, so if you're lost there, absolutely. I'm lost there too. So let's just do a little bit of a comparison between fiat currency and cryptocurrency. So if you're not familiar with the word fiat, it's everyday money that we use in whatever currency, in whatever place you live. Australian dollars, US dollars, the yen, just fiat currency, day-to-day money. So look at fiat money. It's got a physical representation. We can touch it and feel it like a banknote or a coin, but really, is that really what we've got? A physical representation? But if you think of your bank balance, it's really just a number in the bank's computer, which for simple terms, let's just call that electronic ledger. Now, once upon a time, I'm not a historian on money or anything, but my understanding was that the currencies of nations were backed by gold or something, and it was a $1 to $1. I don't think that's actually the case anymore, but it used to be backed by physical assets. But we are increasingly living in a cashless world where we just tap our credit cards and debit cards, so that while we can still have physical cash, the idea of that is sort of slowly diminishing. So we don't actually see cash, and what we think we have is really just a number in a bank's computer. So what does cryptocurrency look like? Well, it's a virtual currency. There's no physical asset or physical representation, I should say, in terms of the notes or coins. That doesn't exist. It's purely virtual. And your crypto balance in your crypto wallet, which we'll touch on in a later slide, well, it's in essence, it's just a number in a blockchain, an electronic ledger. So you've got a bank balance in your internet banking, and you've got a crypto balance in your crypto wallet. It's all electronic. So it's very different implementations and ideas, but it boils down to just a number somewhere out there in the big computer system of the internet.
So can I just stop you here and ask a question?
Yep, certainly.
So I'm just looking at all these numbers, and not being a very analytical person, I look at this and it's scary. It looks like a lot of numbers. But is this, so when you're referring to this as the crypto balance, it's like the ledger that you were showing before, that it's just 2 pages of a ledger, or what exactly am I looking at?
You're looking at there is something I put in there, which was a bunch of numbers, which is just technical stuff. That's not something that you're meant to look at or understand, and I can't tell you anything by looking at that, but that's where people see cryptocurrencies. They see all the computer stuff and in the computer in the movies, and they see like the matrix, all the numbers going, and they go, oh, it's scary, and they get lost in it. That's why that's where that sort of come from. But that was more to go, well, there's no physical dollars you can't hold and think, because when we think about money, well, I do, you think of notes and coins and that. You can put a physical picture in your mind to it. In cryptocurrency, you can't, and you end up with this. At least that's what you see in the mainstream media. You just see numbers everywhere, and it just gets a bit spooky, and I can understand why. But that's just, to me, someone like myself that works in computers, that's just something you see every day. It's not that worrisome, but again, unlike the people in the matrix that look at this stuff falling on the screen, you can see redhead and blonde and brunette, or whatever the quote is. That's just numbers to me, unless you actually put some time into work out what it actually means. But if you think a few slides back, I showed the times reference in the Genesis block of the Bitcoin that had someone had gone through and decoded all those numbers to see what it came through to in English, and noticed that the reference to the newspaper article there. So
before you go on, if I could just ask, and stop me if you would like me to leave the questions for later, but I've written down here the Genesis Book of Records. That's something that I came across a couple of times, but I don't really understand. Can you explain what it means and what that article actually meant on the previous page?
Okay, so, yep, we'll go back. This one here.
Yes.
So this is excuse me. The thing about talking about crypto or blockchain in general, you've got to cover a lot of concepts that stand in isolation until you get to a point where you can start linking things back together to understand how it all fits together in a big picture. That's certainly one of the challenges of this domain, because it's so new. You compare that to our fiat system, which we've all grown up with. It's natural. We don't think about how things fit together. We know what a bank is and that, for example. So your question was the Genesis block. What does that mean?
Yeah.
Genesis block just means the first block, the first ledger page in a blockchain, whether it's a Bitcoin blockchain, Ethereum blockchain. There's more blockchains. Which we generally just will think about Bitcoin blockchains today, but it's just the first ledger page in the blockchain, and that's where you see that's the same numbers we would have seen on the other slide. On the right hand side there, it's been decoded, and we see that there's some English letters in there that says the Times, 3rd January 2019, Chancellor of Brink, which points to that newspaper article. So whoever's created Bitcoin has embedded this code in the blockchain. So I've said it's a public ledger, and we think ledger, we think financials, but you can put a comment in there or some text. I think there's databases out on the internet. You can look up all the messages and references that people have put in blockchain, but that was the first one that was inserted in there. And that's, it's just the Genesis block, the first ever block, has this link to this article that is somebody sort of retaliating against the banking and the financial systems. Does that sort of answer your question?
Yeah, look, it's I'm only asking this question because I watched something recently that referred to it was, but it used the word Genesis, and it talked about that this whole code, it's almost like prediction of everything that's happening in the world. And look, I could be totally off base right now, but this is when you showed me this, that somebody decoded this and actually shows up as, hey, there's something coming up in regards to banking. I
find this fascinating too. Maybe there's more stuff in there that people haven't. I wonder what other stuff is hidden there. Obviously, people have gone through and found all these anything like this that might be in the blockchains. But I wonder what else is secretly hiding around too. But I don't know. I can't recall if the word Genesis block is a term that people themselves created after Bitcoin came out, or if it's actually something that was designed in the word Genesis, that is, but that's just what a Genesis block is, the first block of a blockchain. So okay,
all right, I guess that's
that's about as much as I know about sort of this area of the Genesis block and why it started. I just find that quite interesting. I'm not too sure exactly when someone found this, but it would have probably been pretty early on, but in blockchain, but it would have been within the technical people in the blockchain, people working in this, who would have found this, and it would have only sort of got to the masses many years later. Like, a lot of people would have heard of Bitcoin, but it's only been in the last few years that it's really got some traction and people are actually hearing about it. So
beautiful. All right, well, let's get back to the basics. I guess this could be a conversation for another time. It sounds like it's
so we finished here. So the last thing I haven't, it's just not on the slide, but physical currency, fiat money, it's got a value because we've got markets, we trade it, we attach a value to it, so it's important. If we didn't believe in it, it wouldn't have any value. Crypto is exactly the same. If we didn't believe in it and people didn't attach a value to it, it would have no value, but people have. and therefore markets have created where you can buy and sell, and just with market forces, cryptocurrency now has an intrinsic meaning to people, therefore it's got value and we can trade it. So that's in the same way as the physical currency. Gold is just a metal, big deal, but we attach meaning to it. Therefore, we would love to have a few gold bars because we know it's got a value, and other people believe that too. So crypto and fiat, exactly the same idea. I talked in the earlier slide that there are tens of thousands of cryptos. Not all of them have any value that we would want to attach anything to. We'd all love to have 100 Bitcoins, but of those 10,000 coins, we wouldn't care if we had one or 1,000 because it still might only be a couple of cents worth. There's no value to some of those coins. And I guess that's a little bit like some currencies in the world are more valuable than others. The US dollar is sort of the staple, and then some currencies, I'd rather have 100 US dollars in my hand than 100 Australian dollars because it's just worth more. Some cryptocurrencies are a little bit the same. Some are just more valuable than others.
And I think that, sorry, if we can, go on.
Yeah.
I think you
go.
Comparing the two. Yeah. You go on. Sorry, Gary.
Oh, sorry. I was just wanting to ask. I missed the question. Sorry.
No. I was going to ask. I was going to make a comment, but I think that you're actually going to cover in here. About the fact that people think of normal money as something that's tangible. Okay, because we've got the notes. But if you actually look back in history, we've started fractional banking, which means the bank doesn't actually hold anything in there. It's just numbers on the computer. So they will lend you money that they don't actually have and charge you interest on the money that they've never had in the first place. And that sort of created a whole industrial revolution. So even though, we might have a little note and say, hey, that's money, but this is slowly, right now we're going into digital age and slowly disappearing. So we might not be using notes very soon. No.
And look, we've seen that in our lifetime. We've gone from a cash economy, and people use cash, to credit cards and debit cards, and people struggled. There was a generation of people that struggled with the idea that they don't have cash in their wallets and purses, they've got to tap a card. And I know people that have struggled and still prefer to have cash. It's more elderly people, but that's slowly changing. And I think this idea of crypto and that in the future it's no different. It's in my view that it's another transition, and it's going to be a little bit scary and different at the start because people are just not used to it. But it'll just become the norm. Like, we don't think about debit and credit cards now and using internet banking. And if you think internet banking, maybe back in the early 2000s was a bit scary. People, it's a bit risky, you put it online, the hackers will get you, But we transact now, pay our bills, move money around. We don't even think about it these days. This is just the next evolution of this technology. It's going to be a bit scary at the start. There'll be a lot of fear mongering, and people won't be sure. It'll eventually get simpler, and it'll all just become commonplace. At least that's what I think will happen over time. So let's just look at just do a few comparisons between the fiat and the bank sort of system and cryptocurrencies and blockchain, just to sort of set the context and how they marry up, just in some very simple ways. So with your bank, you'll have an account number, usually a BSB number and some account notification. In cryptocurrency, you have something that's called a receiving address. So it's a computer generated number, so it's usually pretty obscure, but you have one. In fact, you have many. You might have hundreds, even thousands, depending on how many you do. You don't just have one, but we'll come to a little bit about how you manage all that later. So that's what you use. You have these address things, and you can use them to receive money. In my banking, this is not my username and password, so don't try and log in. In the banking system, for your internet banking, you have a username and password that you'll go to your bank.com and type in your internet banking app. In cryptocurrency, we have this thing called a private public key set, or public private key set, which is the cryptography that you hear about in terms of blockchains and crypto all the times. These are just computer generated, really long numbers that are hard to guess. The general idea is They're so long, 2 to the 256 power of 256 digits, which is something like more than the number of atoms in the universe. So trying to guess someone's public-private key set is very difficult, and it'll take more time than we've been around, than the universe has been in existence. I think that's the general story about the security of it. So,
how on earth do you remember this?
Well, you don't.
Okay.
This is the low-level detail. So you'll have to remember your username and passwords. We have these things called digital wallets that they generate and they keep all this stuff for us. So you don't have to think about them, but these are just the parallels between the fiat banking system and the crypto world. But we'll see it gets a little bit simpler as we get up to other slides. In our banking world, we have a bank and we have a currency. This is a bit simplified. In Australia, I transact in my bank in Australian dollars. If you're in the US, you would transact in US dollars, for example. In crypto, let's just say one crypto equals one currency. If you have Bitcoin, that's your currency. If you have Ethereum, that's another coin, which is another currency. So you just work what currency, and if you need to convert Australian dollars to US because you're going on holidays, you can do that. If you need to convert a Bitcoin to Ethereum, you can do that through an exchange as well. So you can move things around between different coins, and look, if you need to. So yeah, currencies can be converted just like in the real world.
Okay.
In the banking system, or in the real world, we have a wallet or a purse, which is something is physical, and in that we put our cash, our debit cards and credit cards, if we like. Here we can stick a picture of the family, or we can put some notes if you want. And in the crypto world, or the blockchain world, we have a wallet, which is a digital wallet, and it's a computer program or a phone app. Now, it's not like the tap and go on your phone where you sort of link your bank account. It's an app that keeps and organizes all your public and private keys. Now, there's a few variations on this, so this is one example, but a wallet will keep all your public and private keys, so you don't have to think about them. You never see them even, unless you really want to go looking for them, but it stores them all there, and you will just log into your app, maybe with your Face ID or something, to access your wallet. But we'll see a wallet in a few more slides. As we saw in a Genesis blockchain of Bitcoin, Satoshi Nakamoto someone put a reference to the bank in there, so you can put notes in there against transactions as well, I guess, if you wanted to. In the fiat system, everything's centralized. The banks are owned by the banks, and they're all regulated by governments and other authorities. In the crypto world, there's no regulation or control. It's a decentralized system. It's all free for all, if we want to use those words, but the controls on that, if you like, are the protocols and the technical standards that say how the cryptocurrencies work. What you may come across the word white paper. So there's a Bitcoin white paper, and it explains what Bitcoin is and the technical details of how blockchain works, and that's sort of the technical contract, so to speak. It says this is how Bitcoin works, and if you want to contribute to the system, you need to follow these set of standards according to this white paper, and you can have Bitcoin working. So there's a bit of control that we've all got to agree how Bitcoin works, so the ecosystem works at large, and we'll see a bit about that in the slide coming up. So, any questions on that one before we move on?
All right. Well, I like the idea that the government's not controlling everything, and it's not centralized. So in this case, like let's say, for example, you go for a bank, you get transaction fees, etc. Would you have that in the other one as well?
We will touch on this in another slide.
Maybe I'll leave the questions for later on, because this is really good.
But yes, I will answer that one. Yes, there are transaction fees. You have to pay, and didn't have this in the slide, but it's an excellent point, so I will add it in to the slide that's coming up. But yes, you do pay fees when you use blockchain, but they're nothing like bank fees.
Okay.
A simple example. blockchains are fast, banks are slow.
Yeah.
Banks are expensive, blockchains are cheap. You can move, it costs you the same amount in Bitcoin to move $1 million between two people than it will cost you to move $10. And it'll happen within a number of minutes. I've never moved $1 million at a bank. Can't wait to do that one day, maybe. I'll probably do it in the blockchain, but that's not going to cost you $10 and happen in a couple of minutes. There's going to be all sorts of stuff going on if you try to do that in the bank. In a decentralized blockchain world, click a couple of buttons and that money's moved wherever it needs to go. Probably see why that Bitcoin in the past has had a bit of a reputation of being a criminal's money, and because people can attach value and move all this stuff around outside the banking and the regulation system, regulatory system, very quickly and easily without anyone watching what they're doing, at least, historically. So not all criminals use Bitcoin and not all good people use the banks. I think that's just a bit of one of those mud throwing things that happen and fearful, or it must be dark and bad because criminals use it. But I can see why, but there's a cash economy as well. So
yeah, look, I mean, just from my experience, I know with banking system, I get really frustrated where transfer. I mean, right now transfer of money is a little bit quicker, but now how often were you getting a notification that the transaction will happen in 5 days? They just simply utilize the money to reinvest.
Yeah. I was always of the understanding, I don't know if it's correct or not, in fact, from uni days, that they slow everything down because they can go put that on the short-term money market and make a bit of money, then they give it back to you, so they're borrowing your money for their own benefit. I don't know if that's true or not, but that's what I was led to understand at least 20, 30 years ago. Excuse me. So a few crypto terms. There'll be a few slides where we have to just go over some some terms. So a crypto coin is a crypto asset that has its own dedicated blockchain. So the emphasis here is on the word coin. Bitcoin has its own blockchain.
So
a crypto.
Before you go further, so would that be the same as one page of a ledger? I'm trying to use simple terms.
Simple. So crypto coin.
You know how you were explaining it before, that it's like a ledger.
Yeah. Mm-hmm. Yep. Okay. Let's. You're going to ask me a question. I'm going to come up with simple explanations. So think about Bitcoin has its own blockchain. It has its own ledger book. So it's a big distributed over the internet ledger book, but Bitcoin has its own ledger where all the transactions are just written in it.
Got it.
So that's okay. Might make a bit more sense when I talk about a token.
Yep. A
crypto token is a crypto asset created on an existing blockchain, and they're the basis it should be for smart contracts and NFTs. Now, just to set some context, I'm going to go through these terms relatively quickly and not in a lot of detail, so you're aware of them because you're going to come across them. I'm going to summarize them all in this bit down the bottom in a second. So go with me while I quickly whiz through these terms. A token is like a coin, but it's built on a different blockchain. Now, I won't go into detail here, but Ethereum, for example, is a coin, but you can build other coins on Ethereum. Now, you build a coin on Ethereum, it becomes a token. Now, that's as far as I'm going to go with this, because it does get quite technical, but that's one reason a product like Ethereum, probably products you don't buy it, but in terms of a product sense, but a system like Ethereum has helped cryptocurrency because you can create these tokens on top of another coin, which is sort of ease the entry into creating cryptos, for example, because you haven't got to deploy and set up your own blockchain ecosystem. You're leveraging the existing ecosystem of Ethereum. Now, there are other Ethereum type products or ideas, systems out there, but Ethereum's got the big ecosystem of their blockchain, and then other people can leverage that, or companies can leverage that blockchain to create these tokens that can be traded as if they were coins. So hold that thought as if, and we'll come to that. Now, we have this term called an altcoin. Now, and this is a bit simpler. An altcoin, alternative coin, it's any crypto coin other than Bitcoin. Because Bitcoin is the big granddaddy of cryptocurrencies. Everything else, the 9,999 plus, are all called altcoins. Again, Bitcoin, something, don't quote me on this, like 4 times more money in Bitcoin than Ethereum. And then everything else has got less than Ethereum. So it's just so monopoly-wise in terms of capitalization, Bitcoin is certainly the king.
So would that mean that forever and ever from now on, Bitcoin will always be the most valuable asset?
There's many theories on this, and at this time I'll just go yes.
Okay.
Bitcoin's been considered like gold. Will gold always sort of be like the most valuable metal? Yeah, probably.
Yeah.
So Bitcoin is always going to be the most valuable coin. Yeah, probably. You asked a question before about different coins being like different currencies. Different coins come into existence for all sorts of different reasons. And Bitcoin it's just a crypto coin. It's just, we give it value. It has value, and it's been called the digital gold. It's going to be the place where it holds a lot of value. So for the foreseeable future, yeah, probably it's always going to be like that. We have the concept of a stable coin or stable token, which is a crypto asset that does not fluctuate in value. So why and what does that mean? Bitcoin, for example, you would have all seen the charts even on TV. It goes up and down, $65,000, $45,000, whatever it is, always moving. A stable coin stays at the same value all the time. Now, they're usually pegged or mapped to a like a currency, like the US dollar. For example, the Tether coin is pegged to the US dollar. So one stable coin in USDT or Tether is always equal to $1 US, give or take maybe a cent. So it always stays the same. So why would we do that? Well, these are sort of a vehicle to move money in to crypto from a fiat world and back out, because it's a stable place, but it's also a stable place. So if you were trading and you wanted to pull your money out of, say, Bitcoin that goes up and down, you stick it in a stable coin, and you've locked in that value at $1. So if we look in the classic share markets and that, so you might have some Apple stocks and you bought them at $50, say, and it goes up to $100, and you go, wow, I want to take some of that money. So you take it out of Apple, out of your brokerage account, and you put it in your bank, and then you figure, let's assume there's no brokerage fees, and you get it all, you've got $100 in your bank account. Now, if the price of Apple goes up to 200, you don't get that appreciation, you've just got your $100. But if it goes down to $25, you don't lose either. So you've locked it in at that price in your bank account. That's a stable coin, what it does in the crypto world. And it just means you haven't got to move your money out of crypto into your bank account to try and lock it in. So stable coins are pretty popular in that. Some stable coins, well, they're usually backed from like a currency, probably usually the US dollar. I think there are some that are pegged to gold as well. Some are supposed to be actually pegged 1-to-1, so that there's actually a physical dollar behind a physical stable coin. Whether that's true or not,
is it just one type?
About that. So,
Gary, is it just one type of stable coin, or are there different ones as well?
No, lots of stable coins. There's lots of stable coins out there.
So let's say when somebody wants to start investing in any of these, the first thing you would do is move money from a normal bank to a stable coin, and then
what I think. That's what most of us would do. Yeah, you could. You could go straight from Australian dollars or US dollars into some other crypto, but stable coins just seem to be the way it's done. And look, you don't have to, but everything in crypto tends to be quoted in US dollars when we talk about like real world equivalents. So just as a point, like if I do anything crypto, I just always use US dollars. I never think Australian dollars. The advantage of doing that for someone like you and I in Australia is that, you know, whatever number you see, you're always going to have a bit more because of the currency differences. But yeah, if you hear a price quoted in US dollars and if you hear a dollar figure, for example, quoted in a crypto world, it's usually US dollars implied if it's not spoken about what the actual asset is. We have this idea of a meme coin or a token. This is my definition of it, but it's a crypto asset that has more entertainment value than intrinsic value. Anybody can go out, and it's not that technically difficult, and there's even point and click websites. You can go out and create yourself a coin. That's why there's 10,000 plus. It's not technically difficult because you've got systems like Ethereum where they've got a blockchain ecosystem that you can hop onto and use. So you haven't got to go and set up your whole technical ecosystem. Hence, you can really easily, quickly create coins and meme coins, joke coins. People just put out coins for the fun of it. Is an example of these. I said more entertainment than intrinsic value. That's not always the case. You've probably heard of Dogecoin, Elon Gates' favorite coin. That's classed as a meme coin, but it's got value. People have attached a value to it and they trade it. So it's got some actual intrinsic, that one there has some intrinsic value, but there are other coins out there that people create for whatever reason, that just for fun and jokes. Now, there's also a shit coin, very technical term, but it's a worthless crypto coin with little intrinsic value. As I said, you can go out there and create your own coin. If you wanted to, Anna, you could jump on the net, do some searching, find a website and have your own QMA coin by the end of the day. But it's probably going to fit into this category because there's no intrinsic value and no one's going to buy it. So people have got to want to buy your coin for it to have value. So that's why most of those 10,000 coins fit into these meme coin and S coin sort of ideas. So what does all this mean? Although they're technically and conceptually different, common day-to-day dialogue tends to just use the word token and coin interchangeably. So we'll talk about cryptocurrencies and crypto coins. I've specifically talked about tokens and coins in the bottom, but we just lump them under the word coins when we talk about them every day. But I've just brought this slide to life because you will hear these different ideas, but they're just different classifications of coin. We have a coin in physical currency. It might be an Australian 20-cent piece. It might be a US dollar or some other currencies, but they're still all coins. We just call them coins if we see them. Oh, look at those coins. I found this coin on the street. So in crypto world, we'll just use the word coin in general, but they do mean other things.
So one more question. This sounds really weird and wonderful. I don't know if I'm still clear with the understanding the difference between the coin and the token. Like, is there a different metaphor that you can use? Like when you say coin, I'm sort of referring to $0.25, which is in US, or 20 cents in Australia. So you sort of think of it as a coin. What would be a comparison like if you're to use a different metaphor?
I have tried to think about this because they are technical definitions. Oversimplification, but let's go like this. I have $100 in US dollars in this hand. They're physical coins. I have a check in this hand to Gary Smart for $100 US. One's physical coins, one's just a piece of paper.
Gotcha.
Okay, but as far as we're concerned, I'll take the coin because it's coin. I've got to go to the bank and put the check in to get the money, but at the end of the day, they're still worth $100 to me.
Gotcha.
So it's not quite a one-to-one analogy with a coin and the token, but the same sort of principle. They're still valuable in and of their own right. It's the way they technically come in. I am sorry, it is quite technical, but but yeah, tokens are easier to create than a first-rate coin. It's easier for a bank to print, or let's assume, a checkbook, in the old days at least, than it is to go and mint a physical coin, for example. Just simple knowledge. I hope that sort of gives you some context at least around the difference. So yeah.
That's perfect.
More crypto terms. They'll keep coming, but they will slow down. A smart contract. Now, again, these are words you're going to keep coming along, and these are probably more stuff we will hear more and more about. So I'm just going to give a very simple explanation of these ideas without going into too much detail. But a smart contract is an automatically executing piece of computer code that enforces an agreement between a buyer and a seller. So what does that mean? Well, the picture on the left there is an old school contract. We would sign something. I bought a house, etc., etc. The code, now you'd never, as a consumer and user of the product, you'd never see this, the code, but that's what underlies a contract. You would interact with some sort of contract, usually generated automatically through a computer system or a website or something, for example, but we might have a contract, just as a loose example of buying a house, but it's all done electronically and in code, that at some point this code triggers and it transfers the money from me to you because I bought your house. It's all automatic, it's all on the blockchain. It's signed cryptographically with our public and private keys, and it all happens magically in the blockchain ecosystem versus the old school way. We have a physical paper contract that we have to sign, and it goes through lawyers and this sort of stuff. It's a centralized versus decentralized idea of a contract. So that's what smart contract is in a nutshell. Mm-hmm. NFTs have been getting a bit of press more recently, or a non-fungible token, which is a unique digital asset, often representing a collectible item like music or art. So what's that mean? In the physical world, people collect things. People might collect baseballs or baseball cards, which is some common popularized collectibles, for example. In a digital world, someone might want to collect digital images. So like a digital image isn't physical, and you can print them and copy them quite easily. I can take a picture of Neon Cat here, I think it's, and send you one and send everyone one. Big deal. The idea of a non-fungible token is it's a way to stamp a digital asset as the authentic original, so that you can't copy it. You can have some ownership rights. You can go, I own that image in the first one ever done. Anyone can copy it, just like I could take a photograph of the Mona Lisa and print it off on an A3 sheet of paper and put it on my wall in a frame, but it's not the original. Yeah. That a non-fungible token helps create that authenticity of something. And it would be also used in things like music, for example, in a decentralized world, to maybe get royalties for an artist or something, that they could, this is the original copy of the music, or that's a knockoff copy. And so I'm not, I haven't dove into this too deeply, but yeah, it can be used for that type of system. And we don't go into this in this presentation, but there are there are websites out there where you can buy and sell your digital assets using non-fungible tokens as well. So
that's incredible.
And these are examples of applications and ideas built on blockchain. Now, Bitcoin doesn't really do this. It's just a cryptocurrency, whereas Ethereum and other blockchains, we call Bitcoin Generation 1 blockchain. It's relatively trivial and simple in comparison, but it was the first one. Ethereum and a few other coins are what we call second generation blockchains. They've obviously advanced the technology. As I mentioned before, Ethereum is a blockchain that you can build tokens on, which, as a recap, you don't have to own a blockchain to build a coin. You use their blockchain to build your token on top of, which means, I'll come up with a simple analogy one day, but you can leverage their ecosystem to do some trading. I guess an analogy might be, we just go to the bank and do transactions. We haven't got to go and set up our whole banking computer network so that I can do a transaction with you, Anna. We just use our banks. So the idea of
So if I was to use let's say I mean, this is just, I'm not quite sure if I'm getting this correctly, but let's say, for example, the Quantum Mine Academy logo that I have, can that be converted into a currency? So I can create my own tokens. Is that how it works?
Well, not quite. You could take the first one and assign it in an NFT way to say this was the first ever logo. Now, when QMA becomes really big, that logo might have some intrinsic value. People want to own that first ever logo. And that's where the value from an NFT would come from. NFTs.
But any artwork or anything like that, if you're an artist, you can have the okay, I get it.
Yeah. So these ideas, smart contracts, NFTs, cryptocurrencies is what we talk about and see in the mass sort of medias and that, but they're all built and they're ideas that work on the concept of the blockchain, the applications on a blockchain beyond or in different ways of using a cryptocurrency and idea. So they all mesh and intertwine and get confusing, but they're just different ways of using a blockchain and a tying value to something. So yeah, I wasn't going to go into too much detail other than at least try to give a very high level conceptual idea, because they are concepts that you start to see. And yeah, NFTs have got some press in the last 6 months or so. Yeah, because somebody had a piece of artwork, I think, that sold for $69,000 or something. Hence, it makes the news. So all these different coins and ideas. So what's Bitcoin? I think we've already really covered that. It's a crypto coin. There's some smart contract elements to it, though I don't think that's where its strongest point is compared to the other blockchain like Ethereum and that. So Bitcoin is just a cryptocurrency. At the end of the day, we trade it. It's intrinsic value because we give it some meaning. That's all it is. Now, other coins are created for different reasons. You asked a question earlier on, are different coins just like different currencies? Well, conceptually, yes. If you go to an exchange and trade them, then they just look like currencies. But different coins come into existence for all sorts of different reasons. I talked about a meme coin before, like Dogecoin, which someone just created for fun. So there's nothing behind it. Just someone created for fun. People traded it. Elon Gates tweeted about it, and therefore it's got some value, and people do some stuff with it. Other coins, people just can create coins. There'll be a Save the Planet coin and the Save the Whales coin, and this is my cat coin. Like, you can create coins for all sorts of reasons, no intrinsic value or meaning behind them. They just are created. There are other coins that will be created by companies that are doing something and they're fueling their business on a cryptocurrency. So there's actually a business idea behind the currency. Ethereum, I'll go over this quite quickly and simply. Ethereum is a coin, but it's a blockchain system that you can build other tokens and NFTs on. So there's a business idea behind Ethereum. It's got something more than just being like some numbers in space or the internet that you transact with. There's a business behind it. There's another token, for example, called the Theta token and Theta Fuel token, which there's a business behind that is trying to solve the problem of distributing a high definition media around the place. So on an exchange level, it just looks like you buy Theta and sell Theta. But in a nutshell, the idea of this Theta network is that your TVs and all that will connect to the internet and help distribute high definition content everywhere. So this is the business idea and the application behind it. So, and if your TV is a smart TV and it's Theta capable, for example, and you watch something on Netflix in high definition 4K, your TV downloads it, and then somebody 3 blocks over wants to watch this same content, and they've got a TV that's working on this Theta network idea, they will see that your TV's got this content on it, and it can get it from your TV, rather than the traditional model, whereas it might be stored on a server somewhere owned by Netflix in Australia or Sydney, for example, or the States, and it's got to go over the internet and pull that data to your TV and their TV. This theatre business is trying to solve this problem by having TVs talk to each other, so the content you're getting is closer and you're sharing it. So what does that mean in crypto? Well, if you want to contribute to this, you earn cryptocurrency for hosting that content on your TV. So when someone uses that, you'll get some cryptocurrency for contributing to the network, for example. So you're earning some cryptocurrency for contributing to the network. So that's how the crypto idea sort of comes into play. I'm hoping that makes a little bit of sense. So there's a business idea behind that. Another example of coins being backed by some idea more so than just a coin is one called basic attention token. Now, when we browse the internet these days, you go to Google, it tracks you, it remembers you, you get ads everywhere. And so what's the monetary system behind that? The advertisers pay Google quite a lot of money to put that ad in front of you. You don't see any money, you just get bombarded by these ads. So there's a company out there, and it's behind the Brave, B-R-A-V-E web browser, which is a privacy web browser. Some people may have heard of or used that. But they have this basic attention token, which is a different model for advertising. And under this model, there are three parties. There's Brave, there's me and you as a consumer, and there's the advertising company. So the idea here is that, well, someone wants to market to me, they're going to pay in Brave currency to the network, the media network that distributes this. But if I want to receive ads, I'll actually get a cut of that money myself. So I opt into seeing ads and I get some of the money, and the provider of the network gets some money. So we all win. So that's using a crypto type idea to reward people for seeing ads if you opt into it, versus the classic model, whereas Microsoft or Bing or Microsoft or Google, they get all the money, they push the ads to you. So it's more of it's an inclusive type model based on a blockchain and crypto idea. So there's a business behind that. So there's Theta and BAT, two examples of cryptocurrencies that come into existence because they're backed by a business idea, but rather than just transacting and doing everything in fiat money, they're all blockchain type based ideas. So two examples of many, but yeah, the essence is there are coins out there that have something behind them and a reason for existence, and there are other coins out there that just have no physical reason for being in existence other than somebody created them. Some of them, like Bitcoin being the first, bubbles at the top, or was at the top, it always has been, because we attach meaning to it. And you got things like meme coins that they just get popular and they start to have a bit of value. So many coins just have no value because they created for fun or jokes or whatever, or someone tinkering. So I hope that makes a little bit of sense. So
yeah, look, it's very, very interesting. It sounds like there's just obviously so much learning to do with these, but it's fascinating.
There's always more questions when you jump into this than there are answers. So, and I know we're going through a lot very quickly, but I'm trying to cover, at least make an awareness of some of the core terms you're going to come up with or across as you take this journey. So now this is going to be a very detailed slide. I'm going to go through a simplified version of how the banking system works and a simplified idea of how the blockchain system works. And we'll see how they are similar, but also very different. So a banking system. Okay. So go with me on this example. We have my bank, the bank that I do most of my day-to-day banking with. You have your bank. Let's assume that your bank is different to my bank. And there's someone else's bank, their bank, and there's that bank over there. So there's lots of banks in the world. Now, each bank, these are meant to be pictures of computers in the boxes there. Every bank has its own computer system that they control and operate, and they know where it is. So my bank knows its computer systems. It has people working on them. It is in charge of all their systems, as is your bank. Different bank, different legal entity, different staff, different computer systems, but they're all owned by each bank. Now, we know the banks talk to each other because I can transfer money to you and vice versa, so that even though these are all independent run computer systems and networks for the banks, they do talk to each other, and they charge fees and take 5 days to send money around for whatever reasons, but they do talk to each other. So the banks are in control of their computer systems and their business, but they're regulated by governments and other regulatory authorities that say what and how they can do and stuff like that. So it's a governed system in the bank. We call this a centralized system. Like everything, there is always a central point of control or knowing what's going on. My bank knows its computer system. If something happened and the government official went to the bank and gave them a warrant or something, they could go and find what's happening at their banking system. It's all controlled. It's all knowing and controlled. So I hope that just simply makes some sense. And just for some context for coming up, if we use an EFTPOS machine or go to the ATM, they are owned by our bank. Or more accurately, the bank of whoever owns the actual EFTPOS machine. So if the supermarket is with your bank, then they have a EFTPOS from your bank, and that money goes into your bank through that EFTPOS machines or the ATM machine. So you're using this technology, but you're always interacting with your bank directly. Okay?
Yep.
A bit of context for a future slide. Let's look at the blockchain world now. This might take a little way to sink in, and we could talk all day just on these concepts, but let's see how a blockchain type idea works. You'll hear the word node in blockchain. So blockchain node. So how do I explain this? So your bank, my bank, has their own computer systems that they control, which has their electronic ledgers on it with all your balances. Now, a node in a Bitcoin is just I keep saying Bitcoin, I'm meaning blockchain. A node is a computer that has a copy of the blockchain on it. So we'll just go with the Bitcoin example here. So my node is a computer that has a copy of the Bitcoin, all the Bitcoin transactions on it. Your node is also a computer that you have that has a copy of the Bitcoin blockchain on it. Someone else, their node, has a copy, and there's in that node another node somewhere. Now, I know you, my node and your node, we know each other because we're talking, but someone else could have a node on the other side of the world that we don't know about. We don't know who they are. And that node over there, someone else owns that, or some company. All these nodes can pop up all over the planet, and no one necessarily knows who each other is. So now, how hard is it to put up a node? It's not difficult. You need some computing resources, but you can download some software over the internet for free, install it on your computer, run it up. It takes a few days to download the blockchain, and then you'll have a copy of the blockchain on your computer running a node. Like anybody can do it. Companies do it. I have no doubt that banks, financial, anyone invested in crypto space, institutions would have their own nodes, but anybody can have a node.
So it's like your own bank, right?
Like your own bank, sort of. I'll explain this. I'll keep elaborate on this little example. Now, the nodes all talk to each other in some capacity to synchronize and keep the blockchains up to date. Now, the important point here is that everybody has a copy of the blockchain. Now, in the bank, only your bank has a copy of its electronic records and electronic ledger. My bank has its own copy. They don't know what each other's got. But in this idea, everyone has an exact same copy of the public blockchain. Anyone can contribute, and there's no single point of regulation or control. My node's in Australia, your node's in Australia, their node, it's in the Caribbean, and that node, it's on a little island in Fiji. It could be anywhere. As long as it's got an internet connection, a good fast internet connection, it can be a node. And I think something like Bitcoin, there's over 1,000 nodes, it might be 10,000 nodes, I can't remember actually, across the planet. And it can just keep growing easily. Now, that's just Bitcoin. Ethereum has a different set of nodes, and another coin has a different set of nodes. Now, I mentioned Ethereum can have tokens. Well, if Ethereum had 1,000 nodes, and there's Ethereum coin on it, but someone created a token on top of Ethereum, they're just hopping on the back of all these other nodes that are distributed. They haven't got to go and have their own nodes set up everywhere. So that's coming back to the idea of a token leveraging an existing blockchain without having to have its own just deployed everywhere.
So can I just ask a silly question? So node, would node be like my own private bank account? No, my private bank. So I own my own bank where I store my block. No,
not really. I'm going to elaborate on this a little bit, and you'll hopefully this will come out. So the whole ecosystem of all these nodes create the blockchain network or the Bitcoin network in this example. So if I took my bank over here and just write Bitcoin blockchain across the top, we're all contributing to this ecosystem called Bitcoin and adding more computing power to it by creating a node. So we're all in this together. We're contributing to the network of Bitcoin by creating Bitcoin nodes. So it's not your own personal little bank account, but it's your own public copy of the ledger. Now, do you need your own public copy of the ledger? If you were going to be analyzing a ledger or looking for stuff in it, it might make sense. Or you just might want to help the ecosystem by putting another node out there, because the more nodes, the more secure the network. So really, what's all this actually mean? Well, in this example, we've got 4 nodes, and I can't remember what slide's coming up. So this is a decentralized system. No one is in control. If you're running a Bitcoin node, you're running software that adheres to the Bitcoin protocol, so all the nodes know how to talk to each other. You can't connect a Ethereum node and a Bitcoin node because they're different blockchains. So the blockchains have all got to be in an ecosystem, have got to be compatible. And anyone can contribute. So we haven't touched on wallets yet, but this, for example, is an app. Is a crypto wallet. So in our banking example, I use an FPOS and a bank ATM there. You can do a transaction. So in a crypto ecosystem, you have a wallet. Now, a wallet might be a computer program on your computer, or probably more commonly just something on your mobile phone. I have one and you have one. So when we transact, now this is a little bit of oversimplification, but we will contact a node or nodes and publish a transaction in the big ecosystem that says, Anna is sending Gary 1 Bitcoin, for example. Now, everyone's got a copy of the blockchain. So we'll publish this transaction. I hope this is going to make sense when I explain it. We'll publish our transaction into the ecosystem somewhere, and it'll say, the transaction will say Anna's account -1 Bitcoin, Gary's account +1 Bitcoin. And this is published over the ecosystem, the blockchain ecosystem. Now,
so
nodes add security.
Sorry, so it's like, let's say, like you're referring to this digital ledger. So everybody gets an update saying this has moved from one to the other.
Yeah. Okay, spot on. Let's see what that means in a decentralized system. It doesn't happen instantaneously. It takes some time. You know, Bitcoin takes, let's say, 10 minutes. It's quite slow compared to some other currencies. Everyone in this ecosystem with this public ledger will verify and can verify that your balance goes down and my balance goes up, to say that now I have 1 Bitcoin and you have none. Let's just say you gave me everything you had and I've now got your Bitcoin. So we have this idea of this word called consensus, and you need a consensus of what the ledger is. Now, this is a perfect system. Everyone's honest. Every node in our 4-node ecosystem here is going to put these transactions into the blockchain, and at the balance, it balances off. Anna has no Bitcoin, Gary has 1 Bitcoin, everybody's happy. Let's say a fraudulent person, that node, wanted to fiddle with their public ledger and give themselves 10 Bitcoin. So they got in there, they fiddled with their ledger, they got 10 Bitcoin. So what does that mean? Have they just made some money? Well, their copy of the public ledger is now out of consensus with everybody else. So they've really voided their transaction. They can fiddle with their transaction, but it's not in consensus. So if they tried to send their fake 5 Bitcoin somewhere, it would stand out because it's out of whack with the consensus of everyone. I could have $100 note in my hand, and I could go to my multi-functional printer and photocopy 9 more notes, cut them out, and pretend I've got $1,000. But I'm just deluding myself because I can't take that outside and spend it, because someone's got to go, hang on, you've got 9 fake notes and 1 real one. Same sort of idea and concept here. If someone fiddles with a node or a ledger, it stands out. And when I say the more nodes, the more security, there's just more options for consensus. So that's where the security and the idea of blockchain comes in, to try and keep, with all the cryptography that goes behind it, the system honest and balanced across the ecosystem at large. I hope I've explained that well and relatively simple, but that's how the balances and everything work in a blockchain ecosystem in a decentralized fashion. In the bank, each bank is its own source of truth. In a decentralized system, there are multiple sources of truth that have got to be in consensus. Now, that is quite a simplification, but that's essentially the basics of how the security and the reliability and the assurances of the blockchain type system work. So
yeah, that sounds much more secure.
Any questions on that? That was quite a loaded 2 slides there.
No, this is really, really good, Gary. It's I like all the pictures. I guess I've got 2 questions. One, just a comment. It seems like it's definitely a much honest way of doing it, because who knows where the money is in your bank and who does what and who charges what. Whereas this is a much better way of doing it. The only thing that straight away pops into my mind, I guess you try to be a little bit cynical about something that you don't know about, and my question would be, what if someone steals your phone and just transfers it from one to the other?
Well, that's possible. Someone can steal your wallet.
Yeah.
That's possible. So ideally, you'd have Face ID, you'd have passwords on your phone. So how secure is your app is how secure is your wallet. Do you leave it in the car on the seat with the window open and the door unlocked? So yeah, you got to be careful. But exactly, you got to be careful.
What about if you lose your phone? Is there a way of actually securing it that cannot be touched?
The answer is yes. Now, this is where things get a little more complex and scary, I guess, compared to the real world, because if you lose your password or something in your bank, then you'll have a mechanism you can just go to your bank and go, I've lost my credit card, I've lost my passwords, can you please get me in? It's a central system you'll be able to do it. If you lose your credentials for a blockchain, no one will get it back for you. Wow. You've lost it. So this is a decentralized world. There's no point anywhere that you'll be able to get it back. So you do need to take the effort. Now, I talked about these things called key sets. Your right to a digital asset is your private keys that are sort of embedded behind your wallet. Now, there's a saying in crypto that not your keys, not your crypto. So now, while day to day you never see and use these keys, that's what underlies and gives you the right to these assets in the blockchain. So you've got to keep a backup of them. Now, modern wallets and that, when you set them up, they will use a phrase. You'll type that you'll be given a 12 or 24 letter phrase, usually a set of simple words, which you are asked to write down. And they usually ask you to write them down, not store them electronically, because these phrases are what can generate your public and private key, your private keys. Public, we won't go into keys too much, but you have a private key which creates a public key and creates your receiving and set like addresses. But you get this phrase which you keep somewhere, you print a couple of copies off and you put them in a few locations. So if you ever lost your phone or your wallet, you can restore everything you have by typing this phrase back in. That's sort of the equivalent of a username and password in the crypto world to the banking world. So these credentials,
so if you lose it, you can retrieve it if you have the phrase.
You can retrieve it, yes, but it's your responsibility and my responsibility to make sure I've got these credentials backed up somewhere. Now, if you've got one wallet, you might have one set of credentials, but you might have multiple wallets or something, because not all wallets hold all cryptocurrencies. So you've got to be quite diligent in keeping these things for your own security and peace of mind. There's many stories out there of people who have lost all their cryptocurrencies because Bitcoin was worth nothing and they threw their computer out or something, and they've thrown out $10 million and they can't get it back because they don't know what their keys were or their phrases to access and get it back. Now, modern wallets make it a lot more easy. 10 years ago, it was a lot more hard. It was much more complicated and difficult. So yeah, the take home here is that if you're setting up a crypto wallet, make sure when you print this stuff out, you take a copy, take a copy on a USB stick, put it in a few locations and make sure you know where they are, because without that, you've lost everything. You can't go back and get them back. So I hope that answers that question.
Do you get to choose the phrase that you use, or that's
usually not. It's like simple analogy. You could use your pet's name for a password, but websites discourage that. They say you've got to have one capital letter, one punctuation mark. It's got to be so many characters long. They try to make a hard to guess password. So it'll just generate you a random phrase that's hard, computationally hard to guess and generate.
Yes.
So
this is really exciting.
Okay, I think this is that. So I hope some of that's landed makes sense. There's a lot going on there. It's very simplified, but the basic idea, I hope I've been able to get that across. Even more crypto terms. I think this is the last slide on crypto terms. Just before we get to the next slide. So these are just some terms you'll start to come across. Maybe once, if you dive into the crypto and you take the journey, you'll eventually come across these terms. An old slang in Australian, maybe. CeFi means centralized finance. Then we have DeFi, decentralized finance. We have a CEX, or centralized exchange, and a DEX, a decentralized exchange. So DeFi, CeFi, CEX, and DEX. So you'll come across these terms.
So the ones on the left-hand side. I was just going to say, so one refers to normal banking, the other ones.
Yeah, you're spot on. I thought everyone would sort of pick that up. Yeah, the centralized financial systems is all the centralized stuff, and when the decentralized systems is all the blockchain type stuff. So it's let's leave it there, that one there, and quickly talk about exchanges and wallets. So I mentioned on an earlier slide, in a physical world, you have a physical wallet or purse, you put your cash and your debit and your credit cards in. And in crypto, you have a digital wallet, which is just an app on your phone, and there's squillions of different apps out there for wallets. There are two types in essence. There's a single currency wallet and a multi-currency wallet. When you're entering, you'll usually use a multi-currency wallet, which means you can have different coins in there, and you'll be able to move some capacity usually within these wallets to actually exchange and move coins around. Or there'll be wallets that are single currency wallets only. So if you had two single currency wallets, you own currencies that had to have a single currency wallet, and you had two of them, you'd have to have two wallets, one for each. So why would you do that over multi-currency? Well, the multi-currency wallets are built by companies or people or the community to hold lots of different currencies, but they've all got to be programmed into that wallet. Whereas someone creating a blockchain, for example, will usually create their own single currency wallet, because that'll be the first wallet for that blockchain. And if you want to get onto that currency or idea early on, you'll have to use their wallet because that's the only one that supports it. Now, if they get popular, the multi-currency wallets might sort of pick it up and you can use it there. So there's a capacity that you might need to juggle multiple wallets depending on the journey in crypto you want to take, which is why I stress again, as you do this, you need to make sure you're keeping a copy of your paraphrases and passwords and key sets or whatever you might need, so that you've got access to them should you lose your phone or something. Very important.
Gotcha.
So digital wallets. This is just a screenshot here of the crypto.com wallet. You hodl currencies in wallets. You can send and receive cryptocurrencies between people. I can send you some cryptocurrency through my wallet if I know your receiving address, and vice versa. Wallets, usually you can buy and sell and trade cryptocurrencies for other cryptocurrencies, or you can move them between fiat currency and cryptocurrencies. So a lot of these wallets that are backed or made by companies that run exchanges, and I'll talk about them next, they'll have wallets that have a bridge and an on-ramp there, so you can get money from physical money into the crypto. And it's often crypto.com, for example, it's a bank, you do a bank transfer to them, but there are other places that will take Visa cards, credit cards, PayPal's probably coming out there somewhere along the line. But these apps do provide a way for you to get into cryptocurrency, and it's certainly the easiest way. 10 years ago, it was a lot more complex. Today, it's it's certainly a lot easier, particularly in the last 12 months, 2 years, with everything sort of exploding and becoming really big. So much more is available these days. In fact, there's so much more that you can always get lost on the app stores trying to find something. So, but I'll give you a couple of suggestions soon. Now, there are crypto exchanges. Now, if you've ever seen exchanges for classic shares and securities, you've probably seen pictures a little bit like that, and they all look a bit the same. That's just that example here is just crypto.com. You sign up, you log in, you can see that, you can see the charts, you can buy and sell cryptocurrencies in there. It's really, if you look at the two sets of bullet points, you can hodl cryptocurrencies, buy and sell them, trade them. They're usually multi-currencies and a lot more advanced features if you're trading or want to take your crypto journey further in an investment sense. So think of it, exchanges you'd use if you want to trade and understand cryptocurrencies. Your wallets are probably just more if you're just collecting and getting into it, or you were going to transact in cryptocurrencies. Now, cryptocurrencies at this point in time are their own ecosystem. You can't go and buy a coffee with a Bitcoin. It doesn't work like that these days. It is its own segregated ecosystem. Crypto.com and some other platforms actually provide Visa cards that you buy through them, which you can then transfer your crypto into that card through the app, and then you can just tap it and pay as if it was real money. So there are on-ramps to get your crypto into the real world available. They're all pretty new. Crypto.com is at least 12 months ago, was about the only card I could find that would actually work in Australia. Many of them seem to be very much based in the US, but I'm sure there's more out there now, and there will be more, because they provide a way for an easier way to just spend crypto in the real world by doing sort of automatically through their ecosystem into a Visa card. Without that, you'd have to transfer it back to your bank and then use your bank's credit card. So just as a
question for you, let's say, for example, you own one Bitcoin, and let's say it's worth $65,000 right now.
Yeah.
And you've got that Visa attached, and you want to buy a cup of coffee with Visa card. How would that work? I mean, obviously, can you only spend it $65,000 at a time, or?
No. So in the crypto.com example, now what you would do, you'd go into your app, you would have bought your card through them. You got to apply for a card, you get your card, you would go to the app, and you would just basically if you can see, the bottom icon there is called card. And just like you exchange and might move currencies around, you would just move some Bitcoin into your credit card account. And you might just go, I want to put $100 from my Bitcoin into my credit card account. That gets processed, and now your credit card account has $100 on it. So now you tap it, and that balance will just go down as you transact.
But so the Bitcoin's no longer full.
No. So if you had, I'll keep the numbers simple. If you had 61 Bitcoin at 65,000, and you transferred $1,000 into your credit card, which would for us would be Australian dollars. So that was 1,000 Australian dollars. You'd have $64,000 worth of Bitcoin, 0.901 or whatever that might be Bitcoin. So your Bitcoin goes down, but your credit card balance goes up. So
how do you recoup? How do you recoup that? Can you put in physical $1,000 back into that so you've got a full Bitcoin?
You could, yes.
Okay.
So you could transfer. So in crypto.com, for example, you could transfer in $1,000 from your bank account back into the crypto.com app, and then move that back into the Bitcoin, top it back up. Or you could buy Ethereum or some other coin with it. So this app provides you, I'm talking about two things here really. They do provide a way for you to move money from your bank into the crypto ecosystem or back out, like in and out of your bank. Or they do provide a credit card that you can just use through their ecosystem. So you move your Bitcoin, take a bit of your money out of Bitcoin and put it on your crypto credit card, and now you can use that at a tap and go in a shop, for example. Or the other way is you would take your $1,000 out of Bitcoin, then you'd have to transfer it to your bank, and now it's at your bank in your bank account, and you can use your debit card or credit card and use it in your banking ecosystem. Does that make sense? So
let's say, a different example, let's say you had a Bitcoin and you just went and spent 25,000 out of that Bitcoin. So your Bitcoin's now a percentage of what it's worth, which is worth $40,000. If I come along and give you 40,000 cash, can I buy the Bitcoin from you for the $40,000, but it's just going to be a percentage of it? Or do you have to make it back to $65,000 before I can purchase it?
I'm not quite following the example, sorry.
So let's say, for example, in your wallet you had one full Bitcoin, but then you spend some money out of it, which means your Bitcoin is not full. It's only, let's say, 80%. Okay, or just let's make the figure simple. Let's say it's 60,000, you've spent $20,000, and so your Bitcoin is worth $40,000 because it's not full Bitcoin, it's a percentage of it. Can you transfer that to me if I was to give you $40,000 equivalent to that amount, or do you have to? Or do you have to build it up so it's a full one again before you can onsell it?
No, sorry, yes. I can send, you don't have to buy and sell a full Bitcoin, you can do fractions.
Okay, gotcha.
So I could send you a fraction of a Bitcoin. If I wanted to, you could buy a fraction of a Bitcoin. So you don't have to buy one Bitcoin. And that's the same with most, well, pretty much all cryptocurrencies. You don't have to buy a physical full unit. You can buy parts of it. Now, we talk about Bitcoins. These days, one Bitcoin, two Bitcoins. In the future, if the value of Bitcoin keeps going up, the value of one Bitcoin will be so astronomically high. Let's say it was $1 million. We wouldn't talk in Bitcoins anymore. We talk in smaller units. Like in a physical world, we have dollars and cents, or we might say 2K instead of saying 2,000. So in the future, we might talk about Satoshis. Now, I can't remember off the top of my head what that might be, 1/1,000,000th of a Bitcoin. So today we're talking about one Bitcoin. In the future, we might talk about, I'll give you 2 Satoshis, just because the relative, what that means intrinsically has changed. So, but yeah, today we don't talk about Satoshis, we'll talk about 0.00001 of a Bitcoin, which seems silly when you think about it, because we don't talk about that in the real world. We talk dollars and cents in our currencies. But when you're in a crypto, you might be talking about 1.5376 Bitcoin or 0.0045 Bitcoin, because that equals, and I'm just making his number up, that's $300 US equivalent of Bitcoin. So you just got to get used to these numbers being very small decimals. Now that's Bitcoin. You might deal in another coin that it's only worth $2 US. So now, if I want to send you 10, I have to send you 5 of those coins. So let's just say, I don't know, the ADA coin was worth $5. I can't remember what it's worth. Another coin, it's $5 US a coin, and crypto is $65,000 a coin. Well, I've got to send you $300. I've got to send you a fraction of a Bitcoin, or I've got to send you a whole lot of ADA. So the just like you can't compare $1 Australian to $1 US. One is really Australian dollars 75 cents ish of a US dollar. Cryptos are the same. You can't go 5 coins here is the same as 5 coins there. They're all relative to each other, and hence this idea of a stable coin I talked about before, which is pegged to a single value. You'll often see in the picture, has it there, I'm not sure how clear it would be, and it says DNG/USDT, which is a USD stable coin. You usually will compare coins in a stable coin equivalent value, hence usually US dollars. So just like we talk about Apple stock, just like we might talk about Apple or IBM stocks, we don't look at 10 Apple stocks or 10 IBM stocks. We go, well, this one's worth 500 Australian dollars and this one's worth 1,000 Australian dollars. So we use a common reference point to compare things.
So I guess in simple terms is what we're looking here on the phone. It's like if you had a share market, if you had shares in something that worth X amount of dollars. So this number, the 901, would keep on changing depending on the exchange, not exchange rate, but depending on the value of the shares that you own. So the value of the crypto that you own. Whereas the other one's more like a bank account that's stable, that stays there all the time. Inflation doesn't affect it or anything; it just stays the way it is. So is that right?
That's spot on, absolutely.
Okay.
That's 9,001 US dollars today. Crypto is a lot, like in a share market, people say, traditional investments, 10% a year maybe. Crypto goes up and down so much. You could look at that today and it's $900. You could look at it tomorrow, it could be $1,500. You're really excited. Or you could look at it and it could be $500. Like extremely, that might sound extreme, but it's not unheard of. Things do move pretty rapidly. Bitcoin goes up really high. It's all over the news. Everyone should have invested in it. Next month, it'll take a 30% dip and it's in the news that it's the end of the world. Bitcoin's over. That's just the markets and the Bitcoin and cryptos. They go up and down, a lot more volatile than traditional markets. Now, that's sort of predicted that'll smooth out as it matures and more people get on it, but that's just the nature on it. And if you're going into these coins, that's a ride you're going to have to get comfortable with, and that's a whole bunch of the emotional investor and becoming comfortable with these fluctuations. And there's all sorts of courses out there that do this stuff like to try and, yeah, you've got to take the emotion out of the investment. I think that's investment anyway. You've got to take the emotion out of it. It's certainly here true, because if you watch your wallet every day, you could go nuts because it go up and down, up and down. So
It's no different to share trading where you
no,
do
no,
quick trades, or if you're just an
yeah,
investor. So let's say
just
you
hold
invest
it.
in Apple and you wait 20 years and it goes up in value.
Yeah,
So
yeah.
would
So
it be similar to that? Like, let's say, anyone that's sort of getting into it rather than just get straight into trading where it can get very
yeah,
emotional. I know that, I used to invest in real estate because it's sort of it's a slow climb. Sometimes it goes down, but, eventually it goes up. So if you're investing in something that's good value, so let's say, for example, you go ahead and buy a portion of a Bitcoin or a Bitcoin and just simply sit on it, just forget about checking this wallet all the time and
yeah.
getting stressed, but eventually it goes up in value. Would that be?
That's certainly it. Yeah. I think it's the point I was trying to emphasize there, that it's going to go up and down, swing higher and swing lower than, say, the share market that everyone sort of is more familiar with, even if you're not investing in it. And in traditional investments, cryptos swing higher and lower in shorter periods of time, so that even if you're just hodling your crypto, you might see it move thousands and hundreds of dollars in small, short periods of time. Whereas if you had Apple shares, they'll fluctuate, but not as much. So, look, that can be, you wake up one day and you've made all this money, and it's like, oh wow, that's a great feeling. You wake up another day, all this money has disappeared. That's just the market going up and down, the volatility of it. So crypto is higher volatility, and that's more risk, more opportunity, of course, but that's just the nature of it. What it is. If you look at, I haven't got a chart, but if you look at Bitcoin type charts, it just goes crazy. It just is really, really volatile. But that's part of the journey that you need to be comfortable with. I've mentioned this word hodl. Hodl means hold. So you'll hear this word hodl everywhere in crypto worlds, and it come from a Reddit post early on where someone was spelled hold wrong, and I guess it caught on. So when we hold cryptocurrency long term, it's called hodl. So now I mentioned wallets and exchanges. They really are very similar. You can go to exchange, buy and sell, transfer, and do everything, or you can do it in an app. 10 years ago, things were really, really complicated. Things are getting, as more people get on board, more companies embrace the technologies, things get a lot easier, and that will continue to see that happening. I think it's inevitable that you'll trade cryptos and buy and sell at your banks. They will just make it really easy for you, because if they don't, they're going to miss out, and they'll be able to charge fees. Now, someone put it to me like this once, that post office used to be a central place where you went and paid bills and sent posts and all that sort of stuff. The internet and email came along, and now you don't have to go and send letters at the post office, and you don't have to go there to pay your bills. So we pay them online. The post office is less relevant today than it was 10 and 20 and 30 years ago. So the theory here is that if banks and institutions don't embrace crypto to some extent, they're relevant. They might not become relevant if this doesn't take off. So they're going to embrace it to stay ahead of it, and they'll make it easier for everybody to do, and they'll charge fees and all that sort of stuff, as make some fees out of it. So so it's getting easier as it goes along. I just want to see what my next slide is. There's just a couple of links there on some wallets if you want to do some research, or some exchanges there. Now I'll put SEX and DEX there. So crypto.com and Binance is what we call centralized exchanges. And there's these other ones called DEXs, which are decentralized exchanges, this is a whole nother topic in and of itself, because we talked about centralized systems and decentralized systems. Well, just going to get a little bit more complex now, because you can interact in a crypto world in a decentralized fashion. You keep everything decentralized. use decentralized exchanges and decentralized apps, or you can do it through a centralized system like crypto.com or Binance. Binance is the world's biggest crypto exchange. It's centralized because it's a company that owns an exchange. You go through that company, do everything through that company. So hence it is centralized. If the banks get on board and put crypto buying and selling on their online banking, you're interacting in crypto, but you're doing it through a centralized body. So it's, while it's a distributed, decentralized network, you're actually going through a central channel to get into it. And in that example, for example, the bank will probably know everything you do in crypto land because you're going through their central channel. If you're doing it decentralized, it's no point of control, no single point of reference sort of example, a little bit more anonymous, for example. But it's a lot more complex to do stuff in the decentralized fashion, which is the way it always had to be, but it's in the past, but now things are becoming more centralized and easier, like the crypto.com app or the exchanges, which make it easier for the non-technical people and the masses in general to get into crypto, but they're doing it through a centralized channel. So as I said, it gets complicated fast, but there is centralization within the decentralized ecosystem as well. But this is certainly the easiest way and on-ramp to get onto it. So any questions on that?
Yeah, I do have a question. I mean, the whole idea, from my understanding, is that the whole crypto currency and everything was set up to actually decentralize, the banking system and decentralize everything that you do. So the fact that it's being back centralized, it's to me, it sort of almost seems like, you've got a few people that are controlling the whole world with banking, with everything else.
Yeah.
And you've got this crypto that sort of separated itself, and it's like, let's just do it, properly and honestly. And then you've got these companies going, well, why don't we just centralize it so it's easy for you, and people will get back onto this. Okay, well, it's easy doing it this way, but it's going back to the centralizing thing, which means would that be correct?
That's exactly. They make it easier for it. It's in a decentralized sense, the people are in control, and the banks and governments, they can't control it. But if they start to centralize it, well, you look at the banking perspective, if they make it so easy that the masses use their interface to do crypto, well, they've retained your business and retained your control through their central system, and they can maybe have some dictation to what you can and can't do, and know what you do, for example. So maybe that's a form of corporations taking back control. But they still can't regulate the decentralized blockchain. They can't fiddle with the ledgers and do stuff, but they're in the larger system, but they're funneling you through their ecosystem, and they'll charge you fees and all sorts of stuff on top of it, probably higher. You can interact with blockchains and crypto outside of these central authorities. It's just a little bit more difficult. You got to know what you're doing, and that's probably another step. But it's certainly possible. But without that, arguably, without the centralized ideas coming in to make this really simple, it would be harder for the masses to get on board with it. And the reality is, we still have to. We need to bridge into the physical fiat system to be able to do transactions day to day. It's still time away from you being able to tap and pay a cryptocurrency for your coffee, and unless the coffee shop was happy to take some cryptocurrency, which is probably not, unless they're a crypto fanatic or something. In general, we still need to move things in or out, and the banks and all that will just make it a little bit simpler. But I'll tell you another note on DeFi and that. There is ways to invest cryptocurrencies for, like, lock it up to earn return on it if you've got idle assets and that all exist in a DeFi space. So you can earn 10% or 20% or something on a crypto, many different types. Staking is one that we hear about. I won't say any more on that than if you hear the word staking, it's a way to sort of invest your crypto to earn some return on it. But in a decentralized ecosystem, you're doing that in the blockchain in a distributed way with no central point of control that might fall over and you lose all your money, it's decentralized. Whereas if you put your money in the bank, I don't know, was it the pyramid bank of the 80s or something? People lost lots of money because it crashed. Like in a decentralized ecosystem, well, there's no central point, at least in theory, where things will crash and you lose everything. The most common way of losing crypto is losing your keys or making some error that you can't reverse. And whereas it's a little bit more fearful based, it's a bit more delicate, at least it was, but these centralized make it also a lot simpler. So things were complicated, they're getting a lot simpler. They're getting simpler because centralized systems are helping make it easier and more enticing for people, but the community-driven efforts behind it all are also improving as well. So I'll leave you with the simple analogy that today we transact in an electronic sense with debit cards and that, and we tap and it all just moves around the banks magically. But there's also a cash economy where you can buy efficient chips with some money, and the efficient chip shop might put it through his till, he might not, and might put it through till, he might not, for example. The same parallel sort of exists in a blockchain crypto type world. You could do everything through central channels and these centralized bodies that make it really, really easy. Everything gets tracked. Or you could go the decentralized way, which is a little bit more like the cash economy, where I could just send you some Bitcoin. It doesn't go through any central body. It just goes to you. Yes, it's in a public ledger because that's the idea of it, but it's not a central body who knows and knows what we're doing, sort of. So it's a little bit more anonymous. And that's another topic in and of itself, privacy and anonymity in blockchain worlds as too, because in essence, we can all transact in a crypto world anonymously because no one knows who you are. You have these public keys and that. Yeah, it's just a number. It is just a number. Whereas at a bank, you have an account number, but the bank knows who you are. So they can always tie your name to your number. Now, if you go through these central bodies, they know who you are. You have to do what's known as a KYC, know your customer. So they know who you are, therefore they know your crypto keys, and there's a tracking so of what you do with your crypto keys because they've tied your name to it. Whereas in a DeFi space, you can transact with you are just a number until at some point you tie your name to that number. Nice. So this is why it's a public ledger. We say it's anonymous. It's anonymous as long as you're just a number, but if you're tied to that number, then your transaction trail starts to be seen. Now, that's an oversimplification because a mature wallet, for example, like the Exodus wallet, it's one of my favorite multi-currency wallets, they create public-private keys every time you do a transaction. So if I send you some crypto from a wallet, it'll create me public-private keys, different receiving address. I probably shouldn't be without going to take a different receiving address from my key sets. So I do one transaction with you that appears in a public ledger. Now, if I transact with someone else, I get a different address. So it's not necessarily one linear flow through the entire blockchain. It could be, if I do 100 transactions, I could have 100 different spots. So it's not that easy, but you can bet that there'll be people out there trying to build analytical systems that try and track what goes in these coins to see what people are doing. But yeah, that's the DeFi versus the CeFi type idea of interaction, which a little bit like cash economy and electronic through the bank economy. That's about it for that. So
is this our last slide? Yeah,
that's it. So we've gone for a long time.
This has been fantastic. Like, it's just gone from not knowing anything to right now, you kind of feel like you can have a conversation with somebody about something.
Yeah.
This has been really, really good. And I can, now I can see why people get so excited about these. I think with with a lot of regulations coming in different countries in regards to just every the government or the people that know everything about you, and it's there's just no it's getting scary and scary. Like right now in America, I know they're putting in a bill for that. Every time there's more than $600 that moves in and out, you need to the banks need to notify. And they're trying to put similar things here in Australia as well. So it's there's just no privacy whatsoever anymore, and I think that this is why this this seems like definitely something that's worth exploring or worth getting into, and definitely learning more about it.
Yeah. See, this is the crazy thing. I'll give you an example of the Binance as the biggest exchange. Now, I don't know the technical. I'll give 2 examples actually. I don't know the full details, but there were regulations in the US, to my understanding, that said what you can and can't do with cryptocurrency. So there is a Binance.us website and a Binance.com website. Legally, I guess, if you're in the US, you're supposed to use Binance.us website because it abides by the laws of the US. But anyone can just get a VPN, what we call a VPN or a computer program, or go to this other website that doesn't abide by whatever those restrictions might be and transact. So this is an example of the decentralisation. Someone can make a ruling that you can't do something, but it's the internet. You just go somewhere else and do your transaction, so they haven't really achieved it. There was a court case or something in the US that, I don't know, someone pretended to be Satoshi Nakamoto and said, I made Bitcoin. I think this is what the story was. Someone said, I made Bitcoin I think it was in London. And of course, no one contested him. So I think they were ruled in his favor. And part of that was that, well, if you're using Bitcoin, you're using my intellectual property. So I think it's bitcoin.com or bitcoin.org. You went to that website. Now, if you were in the UK, there was a big red message across the top going, you can't download this software because of intellectual property rights in the UK. What does that mean? You get a VPN. Someone's only got to install a VPN or go to the internet and bypass all that and download it. Like, it's trying to put restrictions on something that's decentralized. There's another avenue. So this is decentralized versus centralized. If a regulation come out and the bank had to do something, it would be stopped and you couldn't do it because it's centralized and regulated. Whereas in an ecosystem, they'll pass laws, they'll do stuff, but people will find another way. Like this technology moves faster than regulators can. And it's going to be a cat and mouse game to some capacity. They'll ban Bitcoin in some countries. They have, for example, but it's not going to stop the ecosystem. If people want to use it, they'll find ways to use it. I think that's probably what the scariness of it is to regulators and governments, and that is that there's no central point at which you can take control and do this stuff if the people want it to actually work. So and then we talked about privacy before. There's a whole thing about there's these things called privacy coins as well, which I said there's a blockchain which is a public ledger. There are ideas coming out now that even though things are a public ledger, it adds a whole lot of privacy so that people can't see what people are doing, which some people will I imagine be concerned about too, because it's adding another level of anonymity into what's already a sort of an anonymous system. So other than any questions, that's all I've got.
Fantastic. Yeah, look, I think you've answered all the questions that I had. I'm sure that once I process all this information, there's going to be millions of other questions, and if I guess anyone that's watching this, if you have any questions, come back to obviously Gary, or we will try to create some kind of a program where somebody can sort of going from nothing to really being able to step into this arena and learn a little bit more. But that's yet to come. But yeah, thank you so much. I really appreciate it, Gary.
No, thank you. It was a
Let's just,
pleasure. So.
let's just unshare the screen. There we go. Yeah, so it's been fantastic, so hopefully now people have a little bit more of an idea of what this is all about. I'm sure there's more questions than answers right now, but it's at least it's not it's because to me this was just such and I know for a lot of people it's just such an abstract thing, but now it sort of has I like the ledger analogy and the wallets and things like that. So it's it's fantastic. Thank you. I really appreciate that.
Yeah. So if I leave you with anything, that look, the world and people, we all went on a journey. Maybe our parents more so than us, but the businesses and people went on a journey from a cash-based system into business had to introduce FPOS machines, and now there's internet banking and credit cards. Like, this was a transition people took time to take, and it didn't happen overnight. Now, this is just another example of that. It doesn't happen overnight, but it'll potentially gain momentum. We've seen technologies come. The internet came out, the World Wide Web came out in 1993. Took a number of years. It's a disruptor. It changed the way we do everything from communicate, emails, to the way we do banking. Phones come out in the iPhone 2010, changed the way we do things. These were significant points of disruption in technology. This blockchain idea is just another technology, disruptive type technology, though the potential of this, and some people are saying, like what we saw the internet do, the World Wide Web and phones, like this will potentially be so minor compared to what this technology could potentially do, because it can change so much of a system that we all have grown up with and take for granted. That's the potential of some of these technologies, but it is also very new, so it'll take time to see how it pans out. And I think, I reckon it's going to be a bit of a cat and mouse game between banks and governments and blockchain ideas, but it's not going to go away. And that's the idea of decentralization. The internet, created by the military, I think back in the 60s, a decentralized network, so that if part of the network was bombed, for example, the whole internet doesn't shut down. If your ISP or your exchange, like telephone exchange, dies, you don't lose, the whole world doesn't lose the internet. The blockchain type ideas is a bit the same. It's not, you can't shut it down like you can shut down a centralized type system. So
yeah, fantastic. Thank you so much, Gary. This has been really,
you're
really
welcome.
it's been amazing. So thank you, and I'll stop recording here. If anyone has any questions, just obviously get back to you.